Today, we're going to look at the company, the Progressive Corporation, headquartered in the United States and traded on the New York Stock Exchange under the ticker PGR. Please stay tuned for the important disclosure information at the conclusion of this video. Founded in 1937 by Jack Green and Joe Louis, Progressive began its journey in Cleveland, Ohio, with a mission to provide auto insurance to those whom other companies often overlooked. From its inception as Progressive Mutual Insurance Company, the firm embraced an innovative spirit that would eventually redefine the entire industry. By the 1950s, the company expanded its reach beyond standard policies, finding its niche in the non-standard auto insurance market. This growth led to its transition into a public entity, officially listing on the New York Stock Exchange in 1971 under the ticker symbol PGR. The 1990s marked a transformative era for Progressive as it transitioned from a niche player to a household name. Under the leadership of Peter Lewis, the company pioneered immediate response claim service and became the first major auto insurer to launch a website, allowing customers to buy policies online by 1997. This digital-first mindset was coupled with a bold transparency strategy, where they famously provided competitors rates alongside their own. In the 2000s, the company introduced the iconic Flow marketing campaign, which solidified its brand identity, while simultaneously launching Snapshot, a usage-based insurance program that utilized telematics to reward safe drivers. Today, Progressive has expanded its portfolio to include homeowners and commercial insurance, standing as one of the largest and most technologically advanced insurance providers in the United States. The Progressive Corporation operates a technology-driven insurance model that prioritizes data-led pricing and multi-channel accessibility. Historically a specialist in non-standard auto insurance for higher-risk drivers, the company has successfully transitioned into a broad market leader. Its core strategy relies on industry-leading segmentation, utilizing telematics programs like Snapshot to offer personalized rates based on actual driving behavior rather than just demographic averages. The business is organized into three primary divisions: personal lines, which covers private passenger autos and recreational vehicles like motorcycles, boats, and RVs; commercial lines, providing liability and physical damage insurance for small business fleets and the transportation industry; and property, which manages residential coverage for homeowners and renters. While Progressive's footprint is predominantly centered in the United States, where it ranks as a top-tier auto insurer, Progressive targets a diverse customer base, ranging from tech-savvy individuals who prefer direct online and mobile interactions to those who value the personalized advice of its network of over 40,000 independent agents. A key strategic focus is the Robinson segment, profitable households that bundle auto and home insurance, which fosters long-term loyalty and higher retention rates. This dual distribution model, combined with constant digital innovation, allows Progressive to maintain high operational efficiency while meeting the evolving needs of both individual and commercial clients. Tracing the trajectory of the Progressive Corporation over the last 2 decades reveals a narrative of aggressive expansion and technological dominance in the insurance landscape. Founded on a culture of innovation, the company transitioned from a specialized niche player into the second-largest auto insurer in the United States, consistently leveraging data to outmaneuver traditional competitors. This growth was catalyzed by a relentless focus on the personal line segment, which remains the cornerstone of its financial architecture, encompassing private passenger auto and recreational vehicle insurance. The early years of this period, specifically around 2006 to 2008, were marked by steady performance despite the looming global financial crisis, with total revenues hovering near $14 billion. As the market stabilized, Progressive's early investment in direct-to-consumer digital tools began to pay dividends, allowing them to capture a larger share of the shifting consumer preference for online quoting and policy management. By 2012, the company successfully crossed the $17 billion revenue threshold, a milestone that signaled the beginning of a decade characterized by double-digit growth rates. A pivotal shift occurred in the mid-2010s as the company diversified its portfolio. While personal lines continued to drive the bulk of net premiums written, The commercial line segment, targeting small business owners and fleet operators, evolved into a powerful secondary engine. This diversification was bolstered by the expansion into the property insurance market through the acquisition of ARX Holding Corp., which allowed Progressive to offer bundled home and auto policies, a strategy aimed at capturing higher value, multi-product households known internally as Robinsons. The most dramatic surge in Progressive's history is evident in the data from 2020 through 2025. Despite the global pandemic, the company's agile pricing models and advanced telematics, such as the Snapshot program, enabled it to maintain profitability while competitors struggled with changing driving patterns. Total annual revenue skyrocketed from roughly $42.6 billion in 2020 to an estimated $87.6 billion by the end of 2025. This explosive climb was supported by 2024 performance that saw personal lines alone generate over $60 billion in revenue, reflecting a dominant market position that continues to challenge the industry lead. Today, the company operates as a financial powerhouse, maintaining a robust combined ratio that balances high growth with consistent underwriting profit. The financial narrative of the Progressive Corporation is a story of disciplined growth and technical mastery over the float, a concept central to insurance profitability. When analyzing the table, the journey begins at the top-line revenue, which has grown from under $15 billion in 2006 to nearly $90 billion in 2026. This trajectory was not linear. It was punctuated by a massive surge beginning in 2018 as the company successfully leaned into its Robinson strategy, targeting multi-product households. The engine behind this revenue is the losses and loss adjustment expenses row. In insurance, this is the primary cost of doing business, representing the actual cash paid out for claims. Progressive's ability to keep this row from growing faster than revenue, often maintaining a combined ratio below 96%, is what separates it from its peers. This efficiency is driven by their telematics data, which allows them to price risk more accurately than traditional models. One of the most critical transitions in this bridge is the unearned premium delta, listed here as the change in contract liabilities. This is a powerful source of interest-free capital. When a customer pays a 6-month premium upfront, Progressive receives the cash immediately, but it is not yet recognized as revenue. As the company grows, this liability grows, providing a massive inflow of operating cash that often exceeds net income. You can see this effect vividly in the 2021 to 2024 period, where rapid policy growth provided billions in cash flow tailwinds. This float is then invested, and the returns from those investments contribute to the other row, reconciliating the underwriting profit with the final operating cash flow. Marketing expenses, which have scaled to over $10 billion by 2025, represent the company's aggressive customer acquisition strategy. Unlike a manufacturing firm, where marketing might be a secondary thought, Progressive views its advertising spend as a primary growth lever. By adjusting this spend, the company can effectively choose how much of the ambient shopping in the insurance market it wants to capture in any given month. Meanwhile, general and administrative costs have remained relatively stable as a percentage of revenue, demonstrating the scalability of Progressive's digital-first platform. Even as they added millions of new policyholders, the overhead required to service them did not grow at the same pace, a classic sign of high operational leverage. The final conversion to free cash flow highlights why Progressive is a darling of the financial markets. The business is remarkably asset-light. Capital expenditures, mostly for software and technology centers, have remained under $400 million even as the company doubled and then tripled in size. This allows for nearly 98% of operating cash flow to be converted into free cash flow. When we look at the final adjusted figure, free cash flow minus stock-based compensation, the growth is staggering. From less than $2 billion in the mid-2000s to over $17 billion by the end of 2025, the company has transformed into one of the most powerful cash-generating machines. This surplus cash has historically been returned to shareholders through unique variable dividend policy, reinforcing the company's commitment to returning excess capital when it cannot be efficiently redeployed into new growth. The financial narrative of the Progressive Corporation is defined by a rigorous and often unpredictable approach to capital return that prioritizes the efficient movement of cash over the comfort of steady optics. Unlike many industrial giants that view their cash balance as a permanent cushion, Progressive treats its balance sheet like a high-performance engine where every drop of fuel must be used or returned. This is most evident in the total dividends paid row. Between 2006 and 2025, the company has operated a variable dividend policy that acts as a pressure release valve. In years where underwriting profits were exceptionally high and the capital required to support new policies was already met, the company has not hesitated to pay out billions. This resulted in the massive $3.80 billion payout in 2021, a stark contrast to the leaner years that followed as the company reinvested into its own growth during more volatile market conditions. This philosophy of capital agility is also mirrored in the company's management of its stock. In the early part of the last 2 decades, share repurchases were a massive part of the allocation strategy. From 2006 to 2013, Progressive was a consistent buyer of its own equity, often spending nearly as much on buybacks as it did on claims-related infrastructure. However, as the business matured and the stock price began to reflect its dominant market position, management shifted away from buybacks. They recognized that at higher valuations, the internal rate of return on a share repurchase is often lower than the return on simply paying out a special dividend. By 2024 and 2025, buybacks have become almost negligible, serving only to offset the dilution from employee stock plans, while the dividend has become the undisputed heavyweight of shareholder returns. Strategic acquisitions have played an incredibly small role in Progressive's history, with the 2015 purchase of ARX Holding Corp. Serving as the lone major exception. This acquisition was a buy versus build decision that provided the necessary scale in the property market to compete with bundled insurers like State Farm. Outside of this, Progressive has stayed away from the M&A treadmill. This organic focus has allowed the company to keep its balance sheet clean and its debt levels predictable. While total debt has risen to nearly $7 billion, it has done so in a controlled manner, primarily used to lock in low-interest financing to fuel the expansion of its massive investment portfolio. This debt is not a burden, but a lever, allowing the company to amplify its investment returns without over-leveraging the insurance operations. The centerpiece of Progressive's financial strength is the $92.5 billion investment portfolio. This is the source of the other income that bridges the gap between underwriting profit and total cash flow. Growing from just over $14 billion in 2006, this portfolio has become a massive, diversified engine of wealth. It is managed with extreme liquidity in mind, ensuring that the company can pay out catastrophic losses from a major hurricane or a spike in auto claims without ever having to freeze its dividend or tap the credit markets. The cash and short-term investments row, which stays remarkably low relative to the size of the company, shows just how efficient they are. Progressive rarely lets more than $1 billion sit idle in a low-yield account unless they are preparing for a massive specific payout. Looking at the conclusion of this 20-year arc in 2025, the company has reached a state of perpetual motion. It generates nearly $15 billion in free cash flow, reinvests what is needed to maintain its lead in the auto and property markets, and returns the rest to shareholders with a level of transparency that is rare in the insurance industry. The projected 2025 performance marks the peak of this cycle, where the company's massive scale and disciplined pricing have allowed it to build a cash mountain that it is already preparing to distribute. This 20-year record proves that Progressive is not just an insurance company, but a sophisticated capital allocator that has successfully turned the mundane world of car insurance into one of the most efficient wealth creation machines in modern finance. The leadership of the Progressive Corporation is currently headed by Tricia Griffith, who serves as the President and Chief Executive Officer. She is 61 years old as of early 2026. Griffith is a quintessential example of internal promotion, having joined the company as an entry-level claims representative in 1988. Over her nearly four-decade tenure, she ascended through various leadership roles, including Chief Human Resources Officer and Personal Line COO, before being appointed CEO in July 2016. Under her direction, the company has seen significant expansion, particularly through the strategic bundling of home and auto insurance. Regarding executive compensation for the 2024 fiscal year, Griffith's pay structure is heavily weighted toward performance-based incentives. Her base salary was $1 million, while her total compensation reached approximately $16.4 million. The ownership of Progressive is dominated by professional entities, with institutional investors holding a commanding 85% to 87% of the outstanding shares. In contrast, individual insiders, including Griffith herself, hold a very small portion of the company, typically estimated at approximately 0.23% to 0.24%. The remaining 12% to 14% of the company is publicly owned by retail and individual investors. The company has limited long-term debt and a significant cash and short-term investments. The liquidation value is estimated at $15.5 billion, or $26.35 per share. Let's build a scenario-based dividend discount model. In the bull case scenario, Progressive successfully transitions from a car insurer to a mobility and lifestyle risk manager. The company leverages its massive data moat to dominate not just auto, but homeowners, renters, and newly launched pet insurance. As autonomous vehicles gain ground, Progressive partners directly with original equipment manufacturers to provide the commercial liability and cyber risk coverage required for self-driving fleets. This case assumes that even as accident frequency drops, the severity of claims remains high due to expensive specialized sensors and repair costs, allowing Progressive to maintain high premiums. The catalyst is a seamless pivot to the Robinson strategy, capturing the entire household's insurance needs and locking them into a technologically superior ecosystem. The base case envisions a steady but slower growth path as the company navigates the maturity of the U.S. auto market and the early stages of autonomous vehicles adoption. Progressive continues to outpace the industry by maintaining its target of a combined ratio below 96, but revenue growth stabilizes as it faces intense competition in the direct-to-consumer segment. The company remains a cash generation machine, primarily returning capital to shareholders through its unique variable dividend policy. Growth is driven by moderate gains in property and commercial lines, offsetting a slow decline in traditional personal auto premiums. The primary catalyst is continued operational efficiency and successful geographic expansion into underpenetrated regions. In the bear case, the rapid adoption of fully autonomous Level 4 and Level 5 vehicles leads to a dramatic drop in accident frequency, forcing industry-wide premium reductions. Automotive manufacturers successfully launch their own integrated insurance products, cutting Progressive out of the value chain. At the same time, increasing climate-related catastrophes cause sustained losses in the property segment that the company cannot fully offset through price increases due to regulatory caps. The catalyst for this scenario is a perfect storm of technological disruption in auto and environmental volatility in property, leading to shrinking margins and a contracting policy base. In the bull case scenario, we assume the following: revenue growth at 10%, operating cash flow margin at 18%, CAPEX growth at 6%, stock-based comp growth at 5%, dividends at 40% of available free cash flow, stock repurchase at 20% of available free cash flow, acquisition spending in the next 20 years at $10 billion. Stock repurchases assumes price-to-sales ratio of 1.2. With this discounted at 7.5%, dividend model yields $383 worth of value per share in 20 years, $774 in 30 years, and $1,418 in 40 years. In the base case scenario, we assume the following: revenue growth at 6%, operating cash flow margin at 14%, CAPEX growth at 4%, stock-based comp growth at 4%, dividends at 45% of available free cash flow, stock repurchase at 20% of available free cash flow, Acquisition spending in the next 20 years at $2 billion. Stock repurchases assumes price-to-sales ratio of 1.2. With this discounted at 7.5%, dividend model yields $193 worth of value per share in 20 years, $299 in 30 years, and $414 in 40 years. In the bear case scenario, we assume the following: revenue growth at 2%, operating cash flow margin at 8%, CAPEX growth at 2%, stock-based comp growth at 3%, dividends at 85% of available free cash flow, stock repurchase at 30% of available free cash flow, acquisition spending in the next 20 years at $1 billion. Stock repurchases assumes price-to-sales ratio of 1.2. With this discounted at 7.5%, dividend model yields $133 worth of value per share in 20 years, $172 in 30 years, and $200 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.